Welcome to this episode of the Michael Yardney podcast, where twice a week my guests and I try and help you master the art of wealth creation through property investing. Now, as we edge towards the end of the financial year, it's the time of the year that we tend to think about numbers and figures and our tax obligations. So today I'm once again joined by Rob Thompson, Assistant Commissioner of the ATO, where we're going to dive into the world of taxation. Today we're going to talk about some different things. I chatted with him last week. This time we're going to talk about some tax tips, the ins and outs of selling property, the nuances of capital gains tax, what you can deduct for your car, what you can deduct from working from home, and a number of other tips to make sure that you get the most deductions you can, but not fall foul of the tax man. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Tax time can be daunting, and all property investors want to make sure they take advantage of all the tax concessions available without falling foul of the ATO. So I'm pleased to have Rob Thompson, Assistant Commissioner of the ATO, back once again. Hi, Rob.
Hi, Michael. Thanks. It's great to be back.
Well, last time we had a bit of a talk about some of the main property expenses of owning a property investment and startup costs, borrowing costs, allocation of costs. So if you didn't listen to last week's podcast, go back to whichever podcast player you're listening to this on and have a listen to Rob then. But what's on the agenda for our chat today, Rob?
Thanks, Michael. Yeah, so look, today on our agenda, it's pretty much all about selling a rental property, capital gains tax, the main residence exemption, which may come into apply, and the need to get a clearance certificate. And then kind of after we've talked through that, given tax time is coming up, I thought I'd share some other tax time tips, Michael.
Sounds exciting. It's a good plan. We've been through much of the buying and holding a rental property, so let's start at the other end of the spectrum. If somebody's thinking of selling a property, and again, I've got to give the disclaimer that we usually give at the end of the show, this is not particular personal tax advice. We don't know your circumstances. We're not saying you should or shouldn't sell property investments. But if you're planning to do, what's the first thing investors should think about?
So, Michael, the first thing that investors should think about, even if they're just thinking about selling, is to make sure that they get a clearance certificate.
I bet you most people don't even know what that is or have never heard of it.
That's why we're here, Michael, to make sure they do. And sometimes they think about it too late. So, kind of let me explain what a clearance certificate is.
Yes, please.
And why it's important. So, you need to have a clearance certificate and provide it to the purchaser of your property at or before settlement. So, if you're an Australian resident for tax purposes and you're selling a property that's worth over $750,000 or more, if you don't have this certificate, a withholding rate of 12.5% on the sale price will be withheld by the purchaser and paid to the ATO. So if you kind of do the rough numbers, that's about $93,750 at a minimum.
Now, Rob, I initially said property investors. Does this apply if I'm selling my home as well?
Yes. So
it's nothing to do with capital gains tax. This is another tax, isn't it? So something most people don't know about. And I do know about it, and I know the reason it came into being. We can talk about that in a moment, but maybe you can give a bit more details and then we can understand why the tax department's doing this.
Yep. So it is called a foreign resident capital gain withholding regime. So it does relate to capital gains. And as you correctly said, Michael, it doesn't matter if you're a property investor. It relates to anyone that's selling a property. So you need to apply for the certificate 28 days before settlement to give us time to process the application. But clearance certificates are free and they're valid for up to 12 months, whether you decide to sell or not at the end of the day. So, our advice is if you're thinking about doing it, apply early. So also, you can do it online and you don't need to have signed contracts, for the sale of your property. If you're thinking about it, make sure you get it. So
Now, a good solicitor or conveyancer will have this as part of their checklist anyway, but I think it's really important to understand the requirement and why we're doing it.
That's right, Michael. But, what we say there is, we know sometimes, there's a lot to do when you're selling your house. You might also be moving into another house, changing jobs, family circumstances, so we just want to make sure that people don't miss it. And what we've found is like some applications go through fairly fast, but if you haven't lodged a tax return recently or you're missing information on the application, which sometimes happens, it can take the whole 28 days. And like last year, we saw about 45% of the certificates we got lodged late. And this puts a risk on the ability for us to provide a clearance certificate at or before settlement. And we don't want to see anyone foregoing, at least about 93 grand on the sale proceeds, just because they haven't got a certificate. And the other thing is then they can't get that money back until they lodge their next tax return. And so, and that's required because lodging a tax return will enable us to determine the final capital gains tax position and whether or not a partial refund of that amount is due. So please, what we'd say is, if you're an Australian resident for tax purposes, don't risk it. Apply for the clearance certificate early and make sure you've got it. If you're a foreign resident, you don't need to, and you'll just have the 12.5% withheld by the purchaser, unless you kind of apply for a variation down, but I'm sure you'll be talking to a tax agent or looking at our website if you've got questions there.
We'll leave a link in the show notes about where you can get one of those certificates. But Robbie, you've a couple of times mentioned something about Australian residents for tax purposes. What does that mean?
Sure, Michael. So I'll explain that, but I might just mention one more thing if I can about the tax certificates. So, we had it recently announced in December that the government was thinking of making some changes to this process. However, these changes aren't law yet, but the announced processes included announcements around the threshold of 750,000 and that being reduced. Now, until it goes through Parliament, it's not law, it's just an announcement. But what we'd say to anyone thinking about selling their house is have a look at our website. We'll obviously update that, and we'll put out some additional communications if that announcement becomes law.
Well, there's no reason not to complete one of these forms. It takes a little while. I've just done it recently because Pam and I sold a property. But having said that, it costs you not to do it, and there's no reason. It costs you if you don't do it, I guess is what I'm trying to say. So there's no reason not to do it.
That's right, Michael. That's right. I think $93,000 is a lot of money for anyone. Make sure you apply. Do continue to have a look at our website, even if you're under the 750,000. If those changes become law, we'll update that. Let everyone know.
Okay, back to what's this Australian tax resident thing?
Yeah, let's talk about that. So some people have a residency status for other government departments, but it's not the same for all. So you need to think about your residency specific for tax when you're thinking about your clearance certificate. And there are a host of things that are to be considered when working out whether you're an Australian tax resident. But a couple of the main reasons kind of why you might be considered an Australian resident for tax purposes are if you've always lived in Australia, or you've come to Australia and you live here permanently, or you've been in Australia continuously for more than 6 months, and most of the time you worked in one job and kind of lived in the same place. So there are other reasons as well, but we have a tool on the ATO website called Are You a Resident? So you can Google that. You can go on our website, or you can go to ato.gov.au/residency, and you can look at that, and that'll help people understand whether they're a resident for tax purposes or not.
Okay, so a tax clearance certificate's a must. Once you've done that, you've put your property on the market, you've sold it, you got the price you want. You don't always get the whole amount or you've got to at least allow for, you get it, but you've got to allow to give something back in the way of capital gains tax when you do your next tax return. So tell us a bit about that and how to make that easier.
So when you dispose of assets, any asset, not just property, could be shares, crypto, capital gains tax needs to be considered. And the most common kind of time when a capital gains tax needs to be considered is when you're disposing or selling of something, like selling your property. But transferring the asset into someone's name, swapping assets, share buybacks, all these things can also be capital gains events. But for property, Michael, it's important to remember that capital gains tax comes into play when you sign the sale contract and actually not at settlement.
Mm-hmm.
And so there's a lot to consider kind of when you're doing your capital gains tax calculations, Michael, and we do see people get these wrong. So a few things to think about here. When you're working out your capital gains, you need to have all the records that come into play. And this, we talked about in the last episode, record keeping, and this is why record keeping from the start and why you own the property becomes really important, because it's going to help you out here a lot. So you're going to have your initial expenses when you first purchase the property. This includes your purchase contract, settlement statement, invoices for legal fees, a lot of things. You're going to have all the expenses while you've owned the property. So council rates, land tax notices, what you've claimed as a deduction for capital works and decline in value. And the third is when selling the property, expenses like expenses including sales contracts, invoices from your real estate agent for commission, advertising costs, they all come into play. But remember, you can't double dip, right? So, it's a bit like good party etiquette, Michael, with the chip and the dip. We're just going to tell people not to double dip, right? So if you've already claimed the expense on your tax return, you can't include it in the cost base of your capital gains tax. And look, your tax agent, once again, your registered tax agent will help you to work out all the details of your capital gain or your capital loss correctly. Or if you're going to do it yourself, is up to everyone to decide how they want to handle their tax affairs. We've got a CGT calculator on our website that people can use, and some fact sheets in our investor toolkit that can help people to understand this.
Now, I want to highlight something that you mentioned as part of the factors to take into account, and that's when you said claim deductions for capital works, etc. Depreciation allowances. Most smart investors have depreciation allowances for their properties because while it actually does cost more to build something today than it did 5 or 10 years ago, in the tax office's department, you're allowed to write off certain items because they've got a lifespan, and also the shell of the building over 40 years. But Rob, if you claim those along the way as tax deductions, you've got to then add them back in when you sell the property. Is that correct?
That's correct, Michael. So if you've bought something, that it's a capital works, and you've claimed part of that decline in value in your previous tax returns, you then can't include that amount in your cost base for your capital gains tax. This does get tricky, right? This is why we say good records through the ownership of the investment property are really, really important, because, then when it comes to selling and you've got to work out your capital gains tax, gain or loss, then, having all this is really going to make it a lot easier for you or for your tax agent, and obviously easier to explain to the tax office if we come and ask any questions.
Well, some people then say to us, well, maybe I shouldn't even bother getting depreciation schedule and claiming those tax deductions if I've got to pay them back. Again, I can't give you personal advice, but my thought would be, hey, it's a cash flow benefit having the deductions now, and you can pay it off later if ever you sell the property, and you may not sell the property. A lot of smart investors hold on to them and pass them on to future generations. So that's one thing that some people, when they sell, don't realise, that they've got to give back some of these deductions. What about the capital gains tax discount? I remember when capital gains tax was introduced. I'm considerably older than you, Rob. And I remember when we first started having to pay capital gains tax, there used to be this complicated formula where the accountant had to work out how much your property would have gone up related to inflation and then discount your capital gains tax by that. And then all of a sudden, thank you, Mr. Taxman, you made it much easier and just gave us a flat rate.
Thanks for the kind comment about age, Michael. I might say that I have been in tax long enough, though, to remember indexation a little bit. So, but look, what I'd say is if you've held the asset for 12 months or more, then you can apply the capital gain tax discount of 50% after you've calculated your net capital gain, but only if you're an Australian resident. So this is where residency comes into play again. Where you're a foreign resident or a temporary resident sells a property, the 50% CGT discounts, the capital gains discount, is prorated and can only be applied to a capital gain when either of the following occur. So when you acquire the asset on or before 8th of May 2012, and they had a period of tax residency after 8th May 2012. So, if you're an Australian resident, a little bit easier. Foreign resident, a few more things you'll need to consider.
Now, again, not giving tax advice, but the concept is, for those who aren't fully familiar with this, when you buy a property for, let's say, $500,000 and 10 years later you sell it for $1 million because it's gone up in value, you don't pay tax on the whole $1 million. You take into account all those things we've already said, including the purchase costs and other costs along the way, subtract deductions you've made along the way, and then you pay. There's not a capital gains tax rate. It adds to the property owner's capital normal tax rate, income, and whatever rate you're paying tax on, it's added to that. But you only pay it on 50% of the capital gain because the theory is along the way a portion of that was related to inflation, and that was that previous indexation we said. Have I explained that properly, Rob?
Yeah, I think generally, Michael, look, one or two comments I make here. You talked about investment structures earlier and perhaps not holding it. You could hold this through a vehicle or a range of vehicles.
Yeah.
The CGT discount is obviously available where you're holding that property directly as an individual. If you're holding it through different types of investment structures, then you may want to go and speak to a registered tax agent or have a look on our website about that. So,
Well, companies don't get the capital gains tax exemption, trusts do, but this is really now the realm of you getting advice, isn't it?
That's right, or having a good look at our website. The second thing, Michael, is you did say earlier that some people aren't selling their property, but they're passing that property on to future generations. As I talked about earlier, capital gains tax can apply when you dispose of that property, which includes when title changes. So, even if you're passing that on to someone else, to one of your kids, you do still need to think about the capital gains tax consequences.
Okay, Rob, and what about if you've lived in the property before renting it out? I mean, a lot of people start with the home, upgrade their home because it's not their final home, and convert it to an investment property. Can you tell us a bit about the main residence exception?
Definitely, Michael. So, firstly, what I'd say is I hope, if someone's doing that, they've had a valuation before renting out your home, because this will help you calculate your capital gains cost base that we've just been talking about. But if you've lived in your property before renting it out and it was your main residence, you still may be eligible for the main residence exemption. But as soon as you use the property to earn income from it, like renting it out or even running a business, it can affect your main residence exemption. Depending on your circumstances, though, you might be eligible for all or part of the exemption. However, this is for Australian tax residents. Foreign tax residents who sell a property after 30 June 2020, so anyone that sells it now, aren't eligible for the main residence exemption unless they meet one of the life event tests. And look, I'm not going to talk about them here, but information's available on our website around what the life events are.
Okay, well, let's talk about something else, though, that I think most people know about but don't fully understand. What's this 6-year rule?
So, Michael, usually your home stops being your main residence when you no longer live there, but there are some certain circumstances where it could still be considered your main residence for the main residence exemption up to 6 years. And the most common reason is where you're moving away to work and renting somewhere else. You can only treat one property, though, at a time as your main residence. The only exception here is where you're moving house, and then you have a 6 months, so you can treat them for 6 months. But if you leave your residence vacant, you can use it as your main residence for an unlimited period. If you make the choice to apply the main residence exemption due to the 6-year allowance rule, though, you should include the exemption in your tax return in the year that you sign the sale of contract for that property. Once again, 6-year rule, the facts around whether someone can or cannot claim it, what impacts it. There's a bit that goes in there, Michael. So we have a number of fact sheets on our website that include these different scenarios around selling the property and the main residence exemption, and include things around vacant land, 6-year absence rule, all of that stuff. So, people can look at our website, look at those scenarios, work out which one's theirs and kind of think about the tax consequences, or, seek some advice from a registered tax agent.
Well, this would apply to expats as well, I assume, people going away for a couple of years and then coming back and having rented out their home, but they don't have an Australian principal place of residence during that period. Would that be right?
So, Michael, that's once again, it's going to come down to whether someone's an Australian tax resident or not. So, once again, we've got a tax residency tool there, worth understanding that and then understanding in what circumstances that can impact.
Okay. Well, the expats are treated very differently also, so maybe a good chat for a future time. We haven't got time for that, but we actually covered a lot. But at the end of the financial year, I guess what some of us would call tax time is coming up soonish. So maybe there's a couple of tax tips you could give us for property investors.
Definitely, Michael. So, I guess first off, one of the tax tips we'd give is that you need to report all the income from your rental property, right? So this includes the gross amount of rent you've received. So that's the amount that needs to go into your tax return. So that's before any expenses are taken out. So if you have a property manager, some property managers might give you the net kind of rental income, so after they've taken some expenses out. But, it needs to be the gross amount. So if you think that's what they've done, or you're not sure, check with your property manager whether the amount that's being recorded is gross or net. You need to include as well any insurance payments that you get.
So just explain that. If there's some damage done to my property and insurance pays for that, and boy, have we had that all around Australia in the last couple of years, that's insurance money coming into your account is seen as income. On the other hand, you're going to have expenses going out on the other side. So it could well be a net figure or probably even a loss after you've got your initial deductibles, but it's still got to be claimed.
That's right. You still need to include the insurance payments in, Michael, as income, and then obviously you've got expenses that might occur.
What about bonds, rental bonds?
So they also need to be included as income, Michael. So any amounts that
if you get some money from it, not when the bond's being held during the tenancy.
That's correct. So at the end of it, if you keep some of the money for the bond, say the tenant's, not paid, done some damage, you need to include that. And something new owners often forget is that if you buy a property to live in and it has tenants until their lease expires or sometime there's some other type of agreement, you need to include all the money you receive from the rent. So for example, you buy a property, you're going to move into it in 6 months, but there's tenants in it for the next 4 months. You've got to include that 4 months of rent in your return.
Now, last year I had a chat with somebody else from the tax department, and I was amazed at how much tax checking you do. So again, this is not to scare people. If you've done everything correctly, there's nothing to be worried about, but you do have access to bank records and other records as well to make sure people get it right. Is that fair to say?
That's correct, Michael. So we have a range of data sources that we use with respect to property investment. And this isn't to try and do the gotcha, right? This is just to try and help people understand what they need to include. But we do have information including rental bond data, we have property transfer data, we have transaction data from short-term accommodations. So, if you've put your property on Airbnb or Stays or any one of those other platforms, you need to return the income. We get property manager data, and I said rental investment property loan data, and we get landlord insurance data. So we get a lot of data that allows us to understand when someone might be renting a house out as an investment and earning some income from it. And typically what we want to do there is we just want to make people aware that they kind of need to lodge a tax return and they need to include that income. So this is, once again, about us trying to educate people about their tax affairs rather than trying to get anyone to go, we gotcha. That's not what we're trying to do here.
I understand that, and that's why I'm happy to have a chat with you, because the aim of these chats is to help educate people and stop them from getting themselves into trouble. I know one way people get themselves into trouble is, and we talked a bit about apportionment last time, is if you've got a holiday home and you some of the year use it yourself and other times have it on short stay accommodation, you can't really claim all the expenses for the time it's your own holiday home, can you?
That's correct, Michael. Like any other expense, you need to apportion between your income producing activities for that asset, like when you're renting it out, and any time you might use it for private use. And so if you are doing that, our investor toolkit's got some information about how to apportion your expenses. Where say you've got a holiday house and, you're renting it out part of the year, and then, other times of the year you might be using that for private.
So your tax resources system actually knows exactly when our holiday homes get let out and when they don't. Just get your sums right, do things the right way, and you won't get into trouble, I guess, is a message I'd like to pass on to our listeners. Okay, another thing is now things have changed from post-COVID. We can see each other, which even though it's only audio recording, I'm working from home. I've done that since COVID and since I've sort of stepped back a bit from the daily running of the business, but I still have a real job and I still work from home. How do I decide about claiming work-related expenses in this new post-COVID environment?
Perhaps I'll talk about work-related expenses, then maybe we can talk about specifically working from home expenses, because there's a few things there that you might want to consider. But really, I'd say generally for work-related expenses that you can claim as a deduction, really the same rules apply. And there's really 3 golden rules, in claiming a work-related expense. You must have spent the money yourself and not been reimbursed by your employer for it. The second is that the expense must relate directly to earning your income. And the third is that you must have a record. Now, this is normally in a receipt, but like for some expenses like car-related expenses, you might have to have a logbook. But, typically that's it. And then obviously as well, you can only claim, if you are claiming, if you've paid something and it relates to both private use, but also you're using that for work, then you can only claim a deduction for the work-related portion. We've talked about good record keeping for investment properties, Michael. This is where good record keeping also comes into a play, because depending on the type of expense, you'll need to be able to show that you've spent the money, how you've calculated it, and any proportion of the expense that's work-related, where you're kind of also using that for private use. And probably the last bit here, Michael, a common mistake we see is people think that they can just use their bank or their credit card statement and that'll do as a receipt. Typically, that's not enough. You actually do need a receipt with respect to that expense and just not your credit card bill statement.
Well, nowadays, I've found it so easy. I've got an iPhone, of course, like a lot of people have smartphones, and there's a number of programs you can just quickly, while it's still fresh in my mind, I take a photo of it. I'm lucky I've got an accounts department that looks after all that for me. So either that or use the various tax programs or record-keeping programs you've got. So it's not hard to do. You just got to keep it in mind, don't you?
That's right, Michael. And probably, a good plug for our ATO app, because our ATO app actually has a My Deductions tool on it. So you can take those photos of your receipts and then they can automatically be uploaded at tax time. So it actually makes it easier for you to do your tax.
Or do you think people want to let you know what they spend? Let's see. That's okay, but it's something that you offer. And by the way, you do know what we spend anyway, so you may as well show it. I've got no issue about that. I did ask about working from home, though, Rob.
Yeah. So for working from home, you are eligible to claim working from home deductions. But, there's a few things here. You must be working from home to fulfill your working duties, right? So, not just minimal tasks.
Is recording a podcast a working duty? I think so.
I think it is, Michael. Don't use that as official tax advice, but
Okay.
So a few other things to consider. Right? You need to have incurred an additional expense from working from home, and you need to have records to show that you've incurred these expenses, as well as the number of hours that you've worked from home during the year. And look, there's two different ways you can work this out, Michael. And it's up to people to decide which method they want to use and which gives them the best result, as long as they've got the records. So it's their choice, right? So there's the fixed rate method, and that's a method that allows you to claim a set rate for every hour you work from home and covers additional running expenses, that sometimes are difficult to apportion between private use and work use, like phone and internet, electricity and gas, stationery, and things like that. But then if you're going to use the fixed rate method, just a reminder, you can't claim those expenses somewhere else on your tax return, so no double dipping. So if you've used the fixed rate method, you can't claim your internet usage for working from home somewhere else. But to claim this method, one thing to be aware of is that the individual needs to be able to show their records for the total hours that they've worked during the whole year. So that can be, they can use their timesheets, a diary, but they do need to have a record around the hours they've worked for the whole year from home. And they also just need to be able to show the additional running expenses they've incurred, kind of a phone bill or your electricity, gas. That's one type of method they can use. And then the second involves a bit more record keeping, but it's called the actual cost method. So this method allows you to claim a deduction for the actual expenses you incur from working from home, though it does require, as I said, a bit more calculation and records. And, so you can say, for example, claim the proportion of your electricity that you think relates to work, but you will need to have records showing how you've calculated that for each expense. So it does involve a bit more record keeping. But it's up to people as to which method they want to use. It's totally their choice. Whichever they think is going to give them the best outcome, they're free to use. And they can look at ato.gov.au/home for more information about both of these methods and the records they need to keep should they want to use them.
Well, I'll leave the links to that in the show note and the other links to the other areas we've been talking about on purpose too, because some people are on the go at the moment while they're listening to this. So rather than trying to remember those things, I'll make it easy for you. Rob, a lot of people have car expenses as well. What can you tell us about these?
So if you use your car for work purposes, you can claim a deduction. And once again, we have two methods. You can use the cents per kilometre method, or you can use the logbook method. Sorry, Michael, I'll stumble on that, but the logbook method. This car can be one that you own, lease, or hire under a hire purchase agreement. So probably a few things here just to people to be mindful of. So when you're considering what expenses you can claim here, now this doesn't include your regular trips between work and home. Okay, you need to be using the car to actually perform your work duties, attend a work-related conference or meeting that's away from your usual workspace, or travelling directly between two places of work. So for example, if you're a tradie and you're going from one construction site to another. If you choose to claim the cents per kilometre method, we've increased this method, increased the rate from what used to be 78 cents up to 85 cents for each kilometre for the 23-24 income year. And that's an all-inclusive rate. So that covers all your eligible car expenses, including rego, fuel, decline in value, insurance. And so once again, you can't claim those again somewhere else on your tax return. But if you choose to use the logbook method, you can claim for the actual car expenses you've incurred, but you do need to have more detailed records, including a logbook and receipts for all the expenses.
Now, again, we can't give individual tax advice here, but the rules did change a while ago for property investors inspecting their own properties as well. So this really, what we just talked about, more relates to what some people would call a real job, even though some people who are listening to this have got very substantial portfolios, and then it is a real business. So again, I guess people have got to get their own advice on that.
That's right, Michael.
Okay, well, we've covered a lot again. Thank you. Some enlightening things there. Any last words?
Just one thing, Michael. Remember, as I said, if you are lodging through a tax agent, you need to give them the whole picture so they can give you accurate advice and they can help you get your tax returns right. So understanding your tax obligations and supplying them with good records along the way is helpful. But, I think we've talked about with everything for tax, good record keeping is key to helping you to understand what you can and cannot claim and how much expense you can claim on your tax return and what income you might need to include.
Well, Rob, you mentioned lots of toolkits, investor toolkits and videos, fact sheets. I'm going to leave a link to all of those in the show notes so people don't have to try and remember. I guess what you're telling us is keep good records, be aware of your obligations, understand what's going on. And if that's the case, you've really got nothing to be worried about from the taxman or woman. I guess we've got to be gender correct nowadays.
That's right, Michael. And I'd add to that as well, make sure you're getting advice from a credible source, so either the ATO's website with respect to tax or using a registered tax agent.
Fantastic. Thank you very much. That was a lot we got through today, and I hope to catch up with you again real soon because there's a few other areas I'd like to talk to you about in due course. Thanks for your time, Rob.
Thanks, Michael.
Well, that was the second interview with Rob Thompson. If you didn't catch last week's one, go back and into wherever you're listening to this podcast and listen to that as well. By the way, if you don't currently subscribe to this podcast on whatever podcast app you're listening to this, or a lot of people are listening to this on YouTube, subscribe so twice a week you get the information my expert guests have to offer. In a moment, I'm going to share my mindset message with you. But I'd just like to point out that it's an interesting time in our housing markets where, well, it's not often that all property commentators and economists agree on something, but currently they seem to believe that the rest of 2024 is going to be a great year for property. And while I don't disagree, the fact that they're all in alignment when they've got such terrible track records of forecasts gives me a reason to worry a bit about their predictions. I think the answer's simple, though. The property markets will perform soundly in the rest of the year, but they're going to be fragmented, which means not all properties, in fact, a minority of properties are what I'd call investment grade. This means many of those who buy an investment are going to sell up in the next 5 years. Well, probably about 50% of purchases if history repeats itself, and those who stay in the game are likely to find their property underperforms the averages, again, if history repeats itself. So how can you beat those terrible odds? Well, you've got to make the right decisions by getting the right advice. Successful property investors understand that getting independent strategic advice is an investment in their property business, not a cost. If you want to outperform the markets this year, when just buying a home even or an investment property, go to metropole.com.au and have a complimentary wealth discovery chat with one of our wealth strategists. Let's explore your options. Remember, we've got no properties for sale and we're much more than just another buyer's agency. We help our clients safely outperform the averages by giving them strategic property and wealth advice. We've been doing it I've been investing for over 50 years. We're using frameworks I've fine-tuned over 5 decades, and we've been helping clients with for almost 25 years now. We've got all the data, but more importantly, we've got the perspective to back up our recommendations. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset session, I'm going to talk to you about the top 5 financial mindset mistakes many people are making. I'm sure by now you recognise I've mentored thousands of people over the last 12, 15 years or so, and I've recognised some common habits that I'd like to share with you. I've also recognised that becoming financially free is about your habits. It's not about getting lucky at the casino one night or some spectacular financial investment that went your way. It's about making good decisions day in, day out, and continuing to make those decisions over a long period of time until eventually they become a habit. And once you commit to becoming financially free, once you commit to becoming wealthy, you see it as a lifelong way of behaving, of thinking, rather than something you just manage to pull off. This means following a few rules on what we allow ourselves to think and dwell upon will get you pointing in the right direction. Now, of course, these differ from person to person, depending upon what your strengths are, your weaknesses are, but each of us should be guided by a few ideas of how we stay on track. Now, on this list could be things that you're going to do every day, like go to the gym, like learn something new, like listen to this podcast, but there should also be things on the list that you don't do. Now, what could they be? Well, they usually start with mindsets. There are a handful of mindsets that people adopt that take up a lot of their time and energy and stop them achieving their dreams, stop them even chasing their dreams. It holds them back. It stops people achieving wealth. So if you can avoid adopting any of the following common 5 mindsets I'm going to share with you, you're already going to be ahead of the game. And the first one is relying on a wage to get wealthy. Now, don't get me wrong. A wage is extremely important, but that's the mindset a lot of people have. Oh, my boss will take care of me, the government will take care of me, the pension will take care of me. Sure, having a wage, a salary will give you a roof over your head, food on the table. I'm not dismissing that, but you won't get ahead. You won't truly get ahead by working for somebody else. Think of all those tech entrepreneurs who've made billions of dollars in recent years. They are all innovators. They work for themselves. Now, you don't necessarily need to be an entrepreneur either. Of course, you can still work for somebody in a 9-to-5 job and on the side build a property investment business, a true business that will one day replace your personal exertion income. One thing's for certain, you need to drop the wage mindset and think like a business person or an entrepreneur. But boy, property business is a fun business to be in. The second mindset you should avoid is thinking investing is too hard. Look, nothing in life comes easy, but you don't need to have worked in finance for 40 years to make good investment decisions. Yeah, you need good advisors, you need to work hard, you need to be resilient, you need to be focused, but don't be fooled when people tell you it's too hard to invest. That's simply a cop-out that they're telling themselves. You see, everything that is easy today was once hard. The third mindset I want you to avoid is thinking money just causes problems. Now, why would anyone think that, you're saying? But boy, are there people out there. It's a big one for many people. There are people out there who think this. They've had a setback and they walk away from investing altogether. They decide, it's not worth it. Money's just not made for them. What they don't understand is that money's for everybody. And it's just what money represents to them that's the problem. Their own failure. But failure is a good thing, and money's nothing to fear or to be intimidated by. It's merely a means to an end. It's merely a way of just setting yourself financially free. That's where you want to head, isn't it? So there's nothing wrong with chasing that, is there? The fourth of the 5 mindsets I want to talk about now is thinking you don't deserve it. It's interesting how often this comes up. It's a subconscious thing. It's not a conscious thing. People won't tell you outright that they think they don't deserve to make money, but they'll show you that they think this way in many other ways. They self-sabotage themselves by blowing their money, by not committing to saving, by not chasing their dreams. They don't prioritize wealth because deep down they think it'll never happen to them. They think like a poor person who's always going to be poor rather than a person who's on their way to achieving wealth. Half the battle in becoming rich is giving yourself permission to become wealthy. And the 5th mindset you've got to avoid is that of being afraid of making a mistake. Now, this is a big one for many, many people. Mistakes aren't a bad thing. Look, no one likes making them, and we tend to fear them. We tend to fear making them. But for some people, it debilitates them. They're so afraid of messing up, they'd rather not even try. Now, how sad is that? After all, this isn't a dress rehearsal and we only have one chance in life to do what we really want to do. And it is what it is. Mistakes are part of life. And the more you aim for, the more mistakes you're going to make. But the only true failure in life is never letting yourself make a mistake. So don't compare your successes or your failures with anybody else. It's just too easy to do that today with Facebook and Instagram, and you see everybody's highlight reels. You don't see the bits on the cutting room explore the mistakes. In particular, don't compare your chapter 1 with somebody else's chapter 12. Can you see how damaging the above 5 mindsets can be, the ones I just discussed? And yet they're very, very common. So ask yourself, have you ever fallen into one of these mindsets? If you have, I bet it's held you back. The good news is there's always time to change them. You see, money doesn't discriminate. It doesn't care who owns it. So why not have your share? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?